So, in the past few years, we've seen a lot of changes. Since 2008, the world has been changing dramatically. In a very short period of time, over a period of under 4 years, everything we knew, everything we assumed was taken for granted, has actually changed. In the region, closer to home, foreign direct investment has actually also been reduced. If we look at the distribution of foreign direct investment, the Levant was still holding until last year when the events in Syria started, then it actually followed the trend across the region. If we look at, and this is important actually, when you talk about foreign direct investment, there's a direct correlation between FDI and job creation. So the less FDI we have in the region, either from outside the region or from within the region, intra-region FDI into developing markets, that means there will be less job creation that is induced by foreign direct investment, and there will be more requirement for local investment to compensate for job creation. And with countries that have no ability to invest locally in their local markets, then this could cause further issues in job creation. The telecoms industry has been a major attractor of FDI in general because of the scale and size of infrastructure and telecom networks. And if some of these countries who require to create jobs and have no ability to invest internally continue to wait and see without opening up their markets to attract foreign direct investment, particularly in the telecoms industry, which is quite attractive for FDI, then they risk further issues with job creation in their markets in the next few years. In terms of M&A activities, they have dropped significantly. 70% year-on-year drop between 2007 and 2011. So again, that is a result of either lack of opportunities, issues with pricing of opportunities, lack of appetite of risk-taking during the crisis. So many issues that have caused this to happen. But this conference has been held on a yearly basis since then, and every year we pretty much repeat the same message, and we hear the same messages, yet we've been seeing a decline in telecom M&A. What's been happening during this period? I like to classify any kind of internationalization process or globalization process of a company into 3 stages. Of course, the early stages where we go into expansion mode, there could be minority shares acquired, looking at accepting limited control but access to new markets, experimental or experiential investments taking place. To secure market share through organic and inorganic growth, this is effectively just to start establishing beachheads around the world in attractive and synergetic markets. The next step in globalization is rationalization, to make sure that you have a balanced portfolio between growth drivers and mature drivers, so you secure long-term growth while maintaining medium and short-term net income contribution to balance the portfolio, increasing the stake in this stage to gain more control over the portfolio, and to increase operational effectiveness so that you can actually manage these companies effectively with the right governance models, with the right KPIs, with the right performance management and executives management. The third stage is more of a growth stage, to take what has been built in the rationalization stage and replicate it and grow it further, to pursue scale and control in a combined manner, and to explore options for scope diversification as well, to supplement or support the scale. I will talk about this a little later. And in this stage also you have the international career management, a more consolidated international operation, and a single look and feel of the whole company. Most regional operators today are moving from the rationalization stage to the smart growth stage. And during the period of kind of slowdown in M&A activities, most of us have actually taken the opportunity to start fixing the house, rationalizing the portfolio, building the internal capabilities, and preparing for when the next stage will come. So this is not just my view, it's actually backed by some evidence. If we look at the M&A activities, the number of M&A in 2007 to 2008 was about 25 transactions, most of which, at the top there, 11 of them were actually non-controlled investments or diversifications. Now, in 2009 to 2012, the total amount of M&A activities dropped about 11. But most of them, the interesting part is, most of these activities are here in the control of existing assets. So companies were actually buying more control in assets they have already bought in this stage. So this is the phase that I'm talking about of consolidation that I mentioned earlier here, or rationalization. And this is the kind of portfolio balance through M&A transactions. If you see these control activities, they have actually happened in both quadrants. In the quadrant of the long-term growth, where there's high level of revenue growth, okay, as well as in the quadrant of high positive net income, where there's immediate or short-term, medium-term net income contribution. So operators have actually been balancing the portfolio by increasing their stakes, mostly in existing assets and in both areas of the matrix. However, during this transition, the telecoms industry transitioning, the world is changing at the same time. It created a lot of uncertainties, a lot of question marks. But one thing that remains fairly certain is the expected explosion and growth that has already started in global data demand. Today, we expect that by 2015, data will be 4 times the level of 2010 across the world. Predominantly, of course, the traffic will be coming from fixed data and fiberization and fiber-based traffic, and very little of it will be coming from mobile. However, the picture is slightly different when you look at CapEx investments requirements, where a lot will actually go into both fixed and mobile. A total of $1.2 trillion expected in building out capacity on networks between 2012 and 2015, both on fixed and mobile networks. So this is a very, very big challenge for the industry. Imagine, you don't have to imagine actually, or live it. Today, we are looking to invest this amount of money in infrastructure. The global economy is not very conducive for investments, yet the telecom sector is seen as one of the main drivers for economic recovery and job creation, and one of the necessities for the continuation of the economies around the world into a sustainable future. So we start looking at adjacent industries and the emerging new telecom space, or TMT space in general. Verticalization in the enterprise side, with a focus on industry verticals from healthcare to banking and commerce, education, etc., where more targeted and defined digitized services can be offered, and there's a lot of growth expected in the already large market there. M-commerce is a very important emerging activity today, particularly that technology is evolving in such a way that it facilitates transactions and enhances security. Machine to machine, and this is where the mobile penetration explosion will actually happen, with beyond 200% penetration with machine to machine communication, estimated at $39.5 billion to grow into that by 2013, not too far from now. And cloud services and other things. Now, all of that still is not enough to compensate for the value being invested in telecommunications networks. These adjacent markets are capable of driving further connectivity, further traffic, and further revenues on connectivity, no doubt, while generating some revenue, but not necessarily a huge part of the revenues of the telecoms industry globally. So there is an expectation also, on the other hand, of growth in data revenues, both on mobile and fixed, although not quite double digits by 2015 in terms of revenues, but nevertheless a steady growth on both sides, given the starting point and given the scale of the telecoms industry. The challenges remain: a flattening ARPU with flat rate pricing. Policy management and throttling will be a key discussion point going forward and a key differentiator going forward for telecom operators to be able to survive in a flat rate environment. Decreasing ARPU and revenue growth, not following the same trends as the underlying demand for data traffic. CapEx and OpEx will increase significantly, driven by data demand, and network deployment costs will reach approximately 3 to 5 times EBITDA, with increasing pressure on profit margins. Also, the rise of unconventional players, voice over IP players, over-the-top players, are creating new opportunities. Although 2 to 3 years ago, we thought these were creating threats. And the industry is now coming to terms with the fact that they're not actually major threats as we thought they would be, but they could be opportunities. What remains is to figure out how to leverage these opportunities. So all of this happening, it adds more questions to strategic decision makers. So what starts to happen in a situation like this? Operators start looking at scale, pursuing growth dynamic and compensate for domestic market situation. This is the first rationale for scale. And to create a global level relationships with the over-the-top players. When you're dealing with the likes of Google, for example, it makes a whole difference if you come and talk to Google about one single small market, or you talk to Google about a global market because they have a global presence, and you roll out global products with Google, with iPhone, with RIM, with Facebook, with Twitter, etc. Preempting competitive threats from other global telecom operators, because there are global operators entering into different parts of the world and different regions of the world, and to be able to preempt the competitive threat coming from them, operators need to be global. And finally, to acquire a global know-how, technical, commercial, marketing, etc., where learnings from different parts of the world can actually be brought into different countries and exchanged, where real value can be created on innovation. So, as a result, we see, for example, in Europe, 80% of operations in Europe are owned by global operators. 8% on top of that are regional operators. So either global or regional operators, 88% of them. And the rest, either a local incumbent, only 3% of operators in Europe are still kind of in a single market as an incumbent, and the others are local challengers, predominantly kind of MVNOs and small challenger niche players in Europe. So the vast majority of operators in Europe either own a group or are part of a regional or global group. And that is consolidation. It would be interesting to see now how this is evolving around the world, with the 750 or so telecom operators listed and registered with the GSMA, how many of them actually are owned or own a regional or a global group. So this is a consolidation trend driven by all the challenges that I have mentioned and with the rationales to answer these challenges. Synergy is another reason for actually globalizing and growing the scale. There are two types of synergies. The first one is kind of intra-group, within the group itself, of companies that are either fully or partially owned by one set of shareholders. Wholesale, procurement, roaming, end-to-end, and there are various ways of executing synergies. And the overall value of synergies must not be underestimated. Over the past 2 years, we've been accelerating our synergy program across the globe, and we have realized triple-digit millions of dollars in direct savings and over $1 billion in net present value of synergies as calculated on net present value basis. And that includes a lot of activities and collaboration across various group companies. I'm talking about the STC group as an example. Synergy savings benchmark around the world. In network infrastructure, 10 to 30% can be achieved in a very short period of time. In IT, 5 to 20%. Supply chain, 20 to 40% within the supply chain. And we've seen a lot of examples to the extent that companies like Orange and Deutsche Telekom decided to create a joint procurement company for supply chain activities in Europe to be able to leverage the scale and synergy. And that is the second type that I'm talking about, where two groups with no ownership or cross-ownership collaborate together to create synergy at a global scale. Synergy in handset specification and acquisition, synergy in framework agreements with vendors, cooperation agreements, and joint venture cooperation agreements with common service platforms and data roaming programs. Now this is absolutely a must going forward. Given the $1.2 trillion of investments in the industry, it is not just a matter of waiting for data demand to go up and revenues to come from that organic growth only, but it's a must to collaborate at an industry level and to also manage to scale growth. So, in a nutshell, just to recap on the key points that we discussed today and a starting point for the future discussions for the next 2 days. I talked about operators in the region are expected to pursue their portfolio rationalization at this stage, given that the M&A scene is a little bit quiet these days. The telecom sector growth is expected to pick up organically, driven by the growing data demand and the existence of new industry players that are driving this demand from the over-the-top side and the adjacency side. There are new growth enablers in adjacencies, and I say growth enablers, not growth sources, because the growth coming from adjacencies, the effort that is required by telecom operators to go into adjacencies is probably not commensurate in all cases with the revenues coming from those adjacent industries. However, these adjacencies are key revenue drivers of the core business, which is connectivity and in the future broadband connectivity starting from today. And operators will need to adapt to new industry trends that are emerging today to capture the growth and maintain profitability. And one larger trend that cannot be ignored is the scale that will remain a priority for operators to safeguard their role in the value chain.